And joining me now to break that all down is Alex Coffey. He is the senior trading strategist at Charles Schwab. Good morning.
It's a pleasure to be here. Thanks for having me.
Absolutely. So, Alex, let's just dive in right here. So, with inflation data coming in line with expectations, how do you see this shaping the Fed's approach to cutting rates next week?
Yeah, it's a great question, and we thought we had it all figured out, right? Pretty much inline data, nothing too alarming in the jobs data last week. Jobless claims this week, relatively anemic, but just when you think you have things figured out in financial markets, they have a way of throwing you a curveball. Of course, we're in the Fed blackout or kind of quiet period from hearing from them directly, but we did see through the preferred vector, at least historically under Jerome Powell, Nick Timiraos over at the Wall Street Journal give us that curveball overnight, where an article was published basically saying that the Fed is still wrestling with the fact that they haven't quite determined 25 basis points or 50 basis points. Market participants often monitor something like the CME Fed Watch tool, which will publish those probabilities based off of Fed funds futures. We saw those odds shift from, let's call it 75, 25, or 3-1 in favor of 25 basis points yesterday to about 55, 45, or basically just a toss-up this morning here ahead of the open.
What is the basis point cut that you would agree to?
I think I could hear the argument for both sides. I think 50 basis points, while it maybe sends an alarming message, if we're truly more worried about the economic trajectory than the inflation picture, maybe rip the Band-Aid off now. Many thought maybe starting in July could have made sense. The market's still pricing in basically 4 25 basis point cuts or 100 basis points in total by the end of the year. So that's going to be, if that's to happen, at least one meeting with 50 basis points. Do you just get that over with to start? Do you try to do so in maybe a November or December after the election? Or perhaps do you skip one of them and just do 50 basis points twice in kind of succession going forward? Now, the market itself, if we're to take it at what Jerome Powell and team has said, which is that they're data dependent, still favors the 25 basis points, and that may be where I would lean in terms of what I expect, because the data itself hasn't really given us anything alarming yet that would push us to 50 basis points.
But why do you believe that a 25-point cut is viewed as more favorable scenario, for equities compared to a 50 basis point cut? And how does this align with the idea of a soft landing?
Yeah, it's an interesting question. I think it comes down to whether or not you achieve the soft landing. So it's not that 50 basis points wouldn't actually be potentially more favorable for equities. It just historically, beginning with the 50 basis points, oftentimes more coincided with the hard landing or recessionary scenario, and sort of indicated that the Fed was panicking, that they were behind the curve, they maybe waited too long, and they had to do a greater cut to kind of kick things off, where the 25 basis point cut a little bit more in line, coinciding more with the maintenance cut, adjusting real interest rates, trying to reduce the restrictive nature of the policy stance to better reflect the declining inflation data. Now, jury's still out. We don't actually know, of course, if we're going to be in a recessionary situation, if we're going to get the soft landing, and whether the Fed goes 50 basis points or 25 really isn't going to make a major difference right now, as it takes a while through those long and variable lags for that to work its way through the system. But them themselves, the Fed that is, have expressed greater concerns about the economic trajectory over the recent meetings than they have inflation. So perhaps 50 basis points would be welcomed by the market.
Now, I want to turn to some new data that came out recently. So according to a recent survey of 500 plus Schwab traders and investors, only about 25% of respondents listed inflation data as the indicator that they are watching most closely in September, given the rhetoric from the Fed throughout the past year about lowering inflation to 2%. So do you think that this was surprising?
It's not totally surprising, and we asked the question a little bit different now than we have in recent months. It was one of the areas that was most focused on in some of the polling data that we conducted in, let's say, June, July, and August. But when we're looking at this particular situation going into September, we asked Schwab traders and investors, you mentioned about 500 plus of them, to select the most the indicator they're watching most closely, just selecting one, and it was only 25 basis points. But I would note, it was only 25% that selected inflation. What I would say, though, is about 50% of those who replied to that particular prompt said that they're watching interest rates. So interest rates kind of encapsulates the inflation data, but it kind of goes to show that it's not necessarily the data itself that we're most concerned with. It's rather the outcome of what the data helps us get to. And so still interest rates are one of the primary focuses of investors, and it makes sense, especially with the Fed meeting centered to kick off the policy stance change just next week.
What are some other economic indicators that traders are most focused on this month, and how will that shape the market sentiment?
Yeah, employment data was, of course, one. GDP rate is another. But if we were to rank order those, interest rates far and away the most closely watched. Second was still inflation, but at 25%, it did come down substantially from some of the numbers that we had seen in recent months. What I found most interesting, kind of to tie things into timely events for this week. Of course, we had the first presidential debate this week. While there was probably not major market impacts from that, one thing that I found very interesting is only about 12% of those who answered the prompt said that they would make decisions their trading decisions based off of short-term news around the presidential election. So as much as we talk about the uncertainty of the election, as much as it's a focus for us as Americans, and we look at these things for other reasons, as far as trading decisions, most investors, by a wide majority, almost 90% of them, are saying that they don't actually make decisions based off the news flow.
And how significant is Jerome Powell's tone and forward guidance expected to be in the Fed announcement? And what should investors listen for in terms of future rate trajectories?
Yeah, I think it's actually more and more interesting now that there is a little bit more uncertainty kind of pushed back into the market, that we don't actually have kind of a clear favorite. Now, this can change in the few days leading up to that meeting, of course, that we'll get in the middle of next week. But right now, with it being kind of a toss-up between 25 basis points and 50, we're going to need to hear, I think, more the reasoning behind it and how close they were to one decision or the other. It's always important to hear confidence from the Fed chair and the team and their message. One thing that Jerome Powell has been very, very keen on is that full unanimous decision. So do we get something with a little bit of dissent? Do we get a little bit more of that in the rhetoric from Jerome Powell himself? And then, of course, if they do go 50 basis points for sake of conversation, are they worried? If you're going to give 50 basis points, it's going to send that message that things are maybe not as rosy as the data suggests. So how does he navigate that situation if that's ultimately the direction they go?
Alex, I do want to get back to the conversation. You mentioned that the presidential debate earlier on had limited market impact, with only about 12% of traders adjusting their portfolios based on short-term political news. So why do you think markets are largely discounting the election outcome for now?
Yeah, I don't know that they're entirely discounting it, because it's hard to really handicap it at the moment. If you look at something like Polymarket, which is one of the most liquid political betting markets that exists globally, it's basically a toss-up between the former President Donald Trump and Vice President Harris at the moment. So if you're trying to price in potential policies based off of whichever administration was to take over in January, you don't really have the idea of which one's going to be based off the current information, unless you feel strongly one way or another and want to make those decisions based off that, and you feel there's a market mispricing. But recent elections have shown elections are really, really close in the U.S. right now. And so we'll see if that continues. It looks as though that will be the case going into November. However, those very contested, close elections also make it probably more and more difficult for one house or the other, one party or the other, to kind of sweep Congress and win the presidency. So if you're looking for more kind of stalemate, sort of a situation when it comes to Washington, more gridlock, which the market sometimes likes because not a lot of change happens, not a lot of uncertainty exists when there's gridlock. There perhaps could be a silver lining in the fact that we don't quite know yet what's going to happen.
Great. Well, thank you so much for all of that important information. I really appreciate you joining us on the show today.